Mic check. Money check. Mindset check. This is Mic'd Up Money Reloaded. Where entrepreneurs talk money, strategy, systems, and execution. No fake hustle, no empty flexing, just real business talk that gets you right. Mic'd Up Money Reloaded, talk that strategy, show it. Systems moving, profit growing, real entrepreneurs already know it. No fake value, better own it. Price meets pain when the bridge is built. Execution turns the vision golden. If the plan is weak, the pressure gets felt. Mic check. Hey. Money check. Mindset check. This ain't just motivation. This is business correction. This ain't just conversation. This is money direction. You want profit, build the model. You want growth, fix the flow. You want increase, check the numbers. What you don't know can stop the show. Mic'd Up Money Reloaded, talk that strategy, show it. Systems moving, profit growing, real entrepreneurs already know it. Hey. No fake hustle, no empty flexing, no more guessing, no more stressing. Money, strategy, systems, execution. Reload the vision, rebuild the plan. Price the value, know where you stand. Mic'd Up Money Reloaded. Bumping 96.3 FM. iHeartRadio, YouTube. Where entrepreneurs talk money, strategy, systems, and execution. Stop just listening. Start applying. Mic'd Up Money Reloaded. Let's get it. Let's get it.
This material is for educational, training, and business planning purposes only. It is not legal, accounting, tax, audit, insurance, employment, investigative, cybersecurity, or HR advice. Business owners should consult qualified legal counsel, CPA/accounting advisors, HR professionals, insurance advisors, certified fraud examiners, forensic accountants, cybersecurity professionals, and other qualified professionals before taking adverse action against any employee, manager, vendor, customer, partner, contractor, or investor. Tool limitation and professional help disclaimer. This episode and the related tools are not designed to catch all theft, fraud, waste, misuse, embezzlement, collusion, cyber fraud, vendor fraud, partner misconduct, or management negligence. The tools are designed to help owners improve visibility, ask better control questions, document patterns, reduce opportunity, and identify situations that may require professional review. Some theft schemes require professional help, such as a forensic accountant, certified fraud examiner, CPA, attorney, HR professional, insurance advisor, IT cybersecurity specialist, or law enforcement, depending on the facts and seriousness of the matter. Suspicion is not proof. Patterns require investigation, documentation, due process, and professional judgment. Do not make accusations, terminate employment, withhold wages, seize property, or contact customers, vendors based only on suspicion or this toolkit. Welcome back to Mic'd Up Money Reloaded. I'm Ephraim Keith Simmons, senior business consultant, business strategist, and professional trainer with more than 36 years of experience helping owners think through money, systems, operations, risk, and business survival. Around here, we do not just talk about making money. We talk about protecting it, tracing it, documenting it, reconciling it, and keeping it from walking out of the business disguised as normal activity. Today's episode is called Who's Zooming Who? And no, this is not just a camera conversation. This is a business control conversation. We are dealing with theft, cash leakage, manipulation, waste, management failure, partner misconduct, owner neglect, and all the ways a business can lose money while everybody is still saying everything looks fine. Let me set the tone early. This is not an anti-employee episode. This is a pro-control episode. Honest employees need systems that protect them from false accusations. Owners need systems that protect the investment. Managers need standards that define performance. Partners need agreements that prevent confusion. A business without controls eventually starts running on memory, mood, and excuses. Here is the big idea. Money should have a trail. Cash should tie to sales. Sales should tie to activity. Activity should tie to labor. Labor should tie to output. Output should tie to inventory. Inventory should tie to purchasing. Purchasing should tie to vendors. Vendors should tie to documentation. Documentation should tie to the bank. When that chain breaks, the money can break with it. The owner question for this episode is uncomfortable but necessary. Where could money, time, inventory, credit, customer relationships, vendor spending, management authority, or partnership trust be diverted before it ever shows up clearly in the books? That is not paranoia. That is risk management with a calculator and a backbone. Some theft is loud. Most business leakage is quiet. It may look like an unreported cash sale, an unexplained bank withdrawal, a vendor nobody recognizes, a refund pattern, a slow work shift, a phone that mysteriously does not get answered, spoiled food that always seems available to take home, or a customer who only wants to deal with one person. And cameras alone will not save the business. A camera can show motion, but controls prove transactions. A camera may show somebody standing at the register, but the POS tells whether the sale was wrong. Inventory tells whether product moved. The bank tells whether the money arrived. If the picture and the paperwork disagree, follow the proof. The strategic challenge today is simple. Ask, how would I steal from me? Then build the process that makes that path harder, makes detection faster, and makes excuses weaker. That one question can reveal cash gaps, labor gaps, vendor gaps, inventory gaps, banking gaps, partnership gaps, and management gaps. So in this episode, we will walk through the major control zones: cash entry points, bank reconciliation, expense documentation, vendor activity, labor and time, revenue by hour, waste and overproduction, company credit resources, customer capture, ineffective management, partnership theft, and owner theft from the business. Strategic hustling moment. If you cannot trace it, do not trust it. If you cannot document it, do not defend it. If you cannot reconcile it, do not call it profit. Let's get to work. Segment 1. Absentee owner blind spots and the no trust system rule. Let us begin with the absentee owner problem. There is nothing wrong with owning a business you are not physically inside every day. That is actually part of the dream for many entrepreneurs. The problem is not absence. The problem is absence without visibility. There is a difference between being absent and being unaware. A strong owner can be away from the building and still know what happened in the business yesterday. A weak system owner can be standing inside the building and still not know what happened with cash, inventory, time, labor, or bank activity. Absentee ownership requires present tense controls. The owner may not be present in the store, restaurant, office, warehouse, clinic, or field site, but the controls must be present every day. The reports must be present, the reconciliations must be present, the review must be present, the questions must be present. Here is the owner question. Can I prove what happened without asking the same person who had the opportunity to hide what happened? If the answer is no, then you do not have a control system. You have a trust fall with payroll attached. Many owners do not discover theft because the theft was sophisticated. They discover it late because the controls were weak. The business did not have daily closeout review. It did not have prompt bank reconciliation. It did not have inventory lockouts. It did not review POS exceptions. It did not compare hourly revenue to staffing. It did not compare vendor usage to revenue. It did not require documentation for every expense. It did not attach paid time to documented work. It let trust substitute for proof. That is how cash leaks become culture. A silent investor has the same issue. If you put money into a business but you do not have review rights, financial reporting, bank visibility, vendor reports, inventory controls, and management accountability, you are not investing. You are donating with expectations. Partners have the same issue. One partner may be active while the other partner is passive. The passive partner may trust the active partner. Fine. But trust does not replace bank reconciliation. Trust does not replace receipts. Trust does not replace vendor review. Trust does not replace payroll controls. Trust does not replace proof of cash deposits. Franchise owners and corporate owners with outside management face the same issue. A manager may be a great talker, great personality, and great team motivator, but the numbers still have to make sense. Revenue should connect to labor. Labor should connect to activity. Inventory should connect to sales. Cash should connect to deposits. Purchases should connect to vendors. Vendor usage should connect to operating needs. A business owner has to stop asking only, do I trust them? The better question is, if trust breaks, will my system catch it? Trust is not a system. Trust is what a good system protects. When owners do not inspect, people begin to improvise. Some will improvise honestly. Some will improvise lazily. Some will improvise selfishly. Some will improvise criminally. The owner's job is to remove as much improvisation as possible from the money trail. That means the business needs written standards. Who can access the register? Who can process refunds? Who can approve voids? Who can order inventory? Who can use vendor accounts? Who can make bank withdrawals? Who can use credit cards? Who can stay after closing? Who can enter storage? Who can handle call-in orders? Who can close online tickets? Who can approve overtime? If the answer is everybody, then accountability is nobody. The absentee owner must build a weekly owner dashboard, not a thick report nobody reads. A practical dashboard that shows cash over or short, POS exceptions, refunds, voids, discounts, no sales, deposit timing, bank withdrawals, vendor changes, hourly revenue, labor hours, overtime, inventory variances, waste, spoilage, customer complaints, and management follow-up. The goal is not paranoia. The goal is control. You do not need to accuse people casually. You need to build a system that lets evidence speak before emotions start shouting. Special segment, partnership, theft among partners. Now let us talk about a form of theft that many business owners do not want to name because it happens inside relationships, inside ownership, inside family deals, inside investor arrangements, and inside partnerships. I call it partnership theft. And before anybody gets defensive, let me define it carefully. Partnership theft is not only one partner stealing cash. Partnership theft is any unauthorized, undocumented, concealed, unfair, or self-serving use of the business, its money, its credit, its customers, its assets, its opportunities, or its information by one partner against the interest of the business or the other partners. In a partnership, access can look normal even when the behavior is dangerous. A partner may have the bank password. A partner may have the debit card. A partner may control the vendor relationship. A partner may handle payroll. A partner may control the customer list. A partner may negotiate leases, sign contracts, approve invoices, or hold the relationship with the bookkeeper. That access can be legitimate, but legitimate access without reporting, documentation, and limits can become a theft pathway. Partnership theft can show up as unauthorized owner draws. It can show up as personal bills paid from the business. It can show up as business credit being used for personal lifestyle. It can show up as expenses coded as operations when they were really personal. It can show up as one partner paying family members or friends without agreement. It can show up as related party vendors. It can show up as fake reimbursements, inflated mileage, missing receipts, or vague consulting fees. It can also show up as opportunity diversion. A partner can divert customers to another business. A partner can use the company's customer list for a side hustle. A partner can send the best leads somewhere else. A partner can use company staff, software, tools, vehicles, credit accounts, or vendor discounts for work that does not belong to the company. That may not look like money leaving the drawer, but it is still value leaving the business. Partnership theft can also be information theft. One partner withholds bank statements. One partner delays financial reports. One partner keeps the bookkeeper relationship private. One partner refuses to provide receipts. One partner controls the numbers and then says, "Trust me." No. Partnership should not mean one person has visibility and the other person has faith. Here is the hard truth. When one partner controls the money trail, the bank trail, the customer trail, the vendor trail, and the reporting trail, the other partner does not really have partnership oversight. They have ownership with a blindfold. Partnership theft can happen through unequal work too. I am not talking about normal differences in roles. One partner may bring capital, another may bring labor, another may bring relationships, another may bring technical skill. That is fine if the agreement says so. The problem starts when one partner quietly stops producing, stops innovating, stops managing, stops selling, stops supervising, or stops contributing while still expecting full financial benefit. That is theft by non-performance. Partners must ask the same questions employees and managers are asked. What did you do? What did you approve? What did you spend? What did you collect? What did you promise? What did you sign? What did you transfer? What did you use? What did you document? What did you hide? A real partnership needs written operating agreements, draw policies, spending limits, reimbursement rules, bank access controls, vendor approval rules, related party disclosure rules, customer ownership rules, non-compete or conflict of interest language where legally appropriate, monthly financial reporting, and independent bookkeeping review. And partners need a no surprise money rule, no unexplained draws, no secret vendors, no personal use of company credit, no family payroll without approval, no customer diversion, no off-book side deals, no private loans using business resources, no bank transfers without documentation, no one partner changing financial systems without notice, no withholding financial statements from the other owner. If the partnership is healthy, controls will not destroy it. Controls will protect it. If the partnership is unhealthy, controls will reveal it. Either way, the business needs the truth. Do not let friendship, family, faith, charisma, or shared history outrank traceability. So for absentee owners, silent investors, and partners, the question is not only, do I trust my partner? The question is, can the partnership prove what happened without depending on the memory, mood, or mercy of the partner who controlled the transaction? Segment 2, how would I steal from me? Cash, bank, expense, and vendor controls. Now let us talk about the owner's most uncomfortable question. Every owner must ask, how could I steal from me? That question is not negative. That question is strategic. If you can identify how the business could be stolen from, abused, misused, slowed down, manipulated, or drained, then you can build the control that prevents it or detects it quickly. Ask, if I wanted to keep a cash sale from being reported, how would I do it? Could I take the customer's money and never ring the sale? Could I use a calculator to make change instead of letting the register create a tape? Could I keep change staged near the register so the drawer does not open? Could I ring up a cheaper item while handing the customer a more expensive item? Could I void the ticket after the customer leaves? Could I create a refund with no customer present? Could I claim a cash shortage was a mistake? Then build the system. Require every transaction to go through the POS. Review no sale drawer openings. Review voids and refunds daily. Require manager approval for discounts. Match camera footage to receipts. Compare product leaving the store to what was rung up. Use daily closeout sheets. Reconcile drawer totals to deposits. Compare deposits to bank activity. Ask, how could I make sure all cash inflows get reported? Start by identifying every cash entry point. The register is not the only entry point. You have cash sales, card sales, online orders, call-in orders, invoices, deposits, tips, gift cards, coupons, third-party delivery platforms, payment processors, refunds, customer credits, prepayments, and bank deposits. Every entry point needs a trail. If a customer ordered, where's the ticket? If the ticket was fulfilled, where's the receipt? If payment was collected, where did it settle? If inventory moved, where is the inventory reduction? If cash was deposited, where is the bank confirmation? If a refund was given, where is the original sale and the approval? If the business cannot trace the inflow, the business cannot defend the revenue. Prompt bank reconciliation is not optional. It is one of the owner's first lines of defense. The bank should not be reconciled once a year at tax time. That is not management. That is financial archaeology. Bank reconciliation must be prompt because theft, errors, duplicate charges, missing deposits, unauthorized withdrawals, and strange vendor payments get harder to investigate with time. The owner needs to know quickly whether the POS total matched the deposit, whether the merchant processor settled correctly, whether cash deposits were made timely, whether there were unexplained withdrawals, whether ACH payments were legitimate, whether debit card charges have receipts, and whether bank transfers make sense. Every expense needs documentation, not just large expenses. Every expense. Who spent it? What was purchased? Why was it purchased? Who approved it? What business purpose did it serve? Where is the receipt, invoice, contract, delivery confirmation, or work order? How should it be coded? Does it match the budget, the revenue level, the inventory need, or the operating plan? Vague expense categories can become hiding places. Supplies, repairs, fuel, meals, miscellaneous, contract labor, emergency purchase, maintenance, operations. Those categories may be legitimate, but they must not become financial junk drawers. Now examine who you are doing business with. Are there vendors on the bank statement that you do not recognize? Are there vendors with vague names? Are there round dollar payments? Are there cash payments with no invoice? Are there vendors only one manager uses? Are there vendors tied to one employee? Are there duplicate payments? Are there vendors whose use has suddenly increased without a clear reason? Sometimes the business is not robbed through the register. Sometimes the money leaves through the vendor list. Vendor abuse can happen with fake vendors, inflated invoices, duplicate bills, personal relationships, emergency purchasing, unauthorized ordering, or legitimate vendors being used too often because management failed to plan. If inventory is constantly short and the manager keeps buying at higher prices, that may not be criminal theft, but it is profit theft by ineffective management. The owner must ask, should we have paid this vendor? Should we have paid this much? Did we receive what the invoice says we received? Did the purchase match sales volume? Did the purchase match inventory needs? Did the vendor's usage increase at the same time revenue dropped? Did someone change payment instructions? Did someone create urgency so normal approval got skipped? If you cannot trace it, do not trust it. If you cannot document it, do not defend it. The business needs an approved vendor list. New vendors should require owner approval. Vendor changes should be verified. Invoices should match purchase orders or receiving documents. Emergency purchases should be tracked separately because too many emergencies are usually evidence of poor planning, poor supervision, or manipulation. This is what I mean by 360-degree control. The register matters, but the register is not the whole business. Cash inflows, cash outflows, bank activity, vendor use, expense documentation, and purchasing behavior must all talk to each other. When they do not talk to each other, somebody else may be talking your money out of your business. Here is the working rhythm I want owners to use. Do not wait for a crisis to ask control questions. Make the questions part of the operating culture. At the end of the day, ask, did every sale get reported? Did every cash drawer close? Did every online order get closed? Did every call-in order get paid? Did every refund have a reason? Did every void have approval? Did every discount have documentation? Did every deposit get prepared? Did the deposit match the closeout? Did the closeout match the POS? Did the POS match the bank settlement? At the end of the week, ask, which shifts had shortages? Which employees had the most exceptions? Which hours underperformed? Which vendors increased? Which supplies were used faster than normal? Which inventory items had variances? Which customers complained? Which calls were missed? Which managers corrected issues? And which managers explained them away? At the end of the month, ask, did gross margin make sense? Did labor percentage make sense? Did food cost or product cost make sense? Did mileage make sense? Did waste make sense? Did vendor spending make sense? Did cash deposits make sense compared to revenue? Did the bank statement tell the same story as the POS, inventory, payroll, and books? This is how you catch a leak before it becomes a flood. The business should not wait until there is a major shortage to become curious. Curiosity should be scheduled. And let me make this practical for the owner who says, I do not have time to look at everything. Fine. You do not have to look at everything every day, but you need a rotation. Monday, review POS exceptions. Tuesday, review inventory variances. Wednesday, review labor and overtime. Thursday, review vendors and expenses. Friday, review bank reconciliation and deposits. Saturday, review revenue by hour and customer flow. Sunday, review the owner dashboard and decide what must be corrected next week. That is not paranoia. That is stewardship. And for the owner who says, I trust my people, let me say it again. I hope you do. But the system should not be built only for the people you trust today. It should be built for the person who may be tempted tomorrow, the person who is under financial pressure next month, the person who learns the gap in your system, and the person who discovers that nobody checks. Segment 4, time theft, slowdown, mileage, credit resources, and customer capture. Now let us talk about theft beyond the register. This is where a lot of owners lose money and never call it theft because nobody physically touched the cash drawer. Time theft is real. Payroll is cash. If someone is being paid for time, that time must attach to documented activity, client work, production work, service work, cleaning, prep, delivery, administrative tasks, training, or some assigned business purpose. Paid time should not float around the building unattached to anything. The owner must ask, what did this person do during the hours paid? What client, order, project, route, station, or task was the time attached to? Did labor hours match sales volume? Did overtime increase without production increasing? Did employees clock in early, clock out late, take long breaks, stand around, run personal errands, or do side work during company time? This is not micromanagement. This is payroll management. If the business pays for the hour, the business deserves the work. Revenue by hour is one of the strongest tools for detecting slowdowns and manipulation. Do not only look at daily sales, look at hourly sales. Who was working during each hour? Who was managing during each hour? How many calls came in? How many calls were answered? How long did customers wait? How many online orders were received? How many drive-through orders were completed? How many refunds, voids, discounts, and no sales happened? Some people do not steal what you made. They steal what you could have made. They do not answer the phone because answering the phone creates work. They let the drive-through speaker sit because taking orders creates work. They ignore customers because service creates work. They move slowly because speed creates more demand. They create bottlenecks because bottlenecks reduce pressure on them. They discourage orders because they want the shift to feel easier. That is revenue suppression. That is theft by slowdown. If one shift consistently produces less revenue with similar customer opportunity, the owner needs to know why. If phone calls go unanswered during certain hours, the owner needs to know why. If online orders sit too long, the owner needs to know why. If customers leave because nobody engages them, the owner needs to know why. Now, watch employees who linger around the business for no apparent reason. Not every lingering employee is doing something wrong, but lingering without purpose is a control issue. Are they on the clock? Are they off the clock but using company property? Are they accessing Wi-Fi tools, kitchen space, office equipment, printers, software, customer records, inventory, vehicles, or supplies? Are they waiting to manipulate overtime? Are they doing their own work using your resources? If an employee is on the clock, the time must attach to assigned work. If an employee is off the clock, they should not be using company resources without authorization. If an employee is not scheduled, they should not be hanging around controlled areas. Mileage theft and vehicle misuse must also be controlled. Mileage logs should connect to actual business routes, client visits, deliveries, deposits, bank trips, vendor pickups, or approved business purposes. Fuel cards should be reviewed. Company vehicles should not become personal vehicles. Business insurance and liability do not need that kind of foolishness riding shotgun. Supplies are another leak. Cleaning supplies, office supplies, paper goods, printer ink, tools, packaging, uniforms, small equipment, phones, tablets, chargers, and food items can walk out slowly. A little bit repeated becomes a lot. The owner should compare supply usage to revenue, head count, service volume, and historical patterns. Unauthorized use of company credit resources is dangerous because the cash pain may show up later. Business credit cards, vendor accounts, fuel cards, trade accounts, lines of credit, online ordering profiles, and purchase cards need access controls. Who can use them? What can they buy? Who approves it? Where is the receipt? Does it match a real business purpose? Customers or clients who insist on dealing with one person only should also be reviewed. It may be innocent. Maybe that person gives great service, but it can also signal customer capture, side deals, cash diversion, discount abuse, underbilling, off-book work, or improper favoritism. A customer relationship can be personal, but the revenue trail must stay business-owned. If one employee controls the customer, the price, the schedule, the discount, the payment conversation, and the follow-up, the business may not truly control the relationship. Customer records, pricing, communication, payments, and discounts must be visible to management and ownership. Finally, be careful with sudden lifestyle changes. Do not accuse people because they bought something nice. People have spouses, savings, family help, side income, tax refunds, settlements, and credit cards. But if sudden visible income appears at the same time, the business has unexplained shortages, suspicious refunds, strange vendor usage, cash drawers short on that person's shifts, customer capture, credit misuse, or revenue drops, then the owner has a pattern worth reviewing. Professional owners investigate records, not rumors. Gossip is not evidence. Documentation is evidence. Patterns are evidence. Reconciliations are evidence. Receipts, logs, reports, footage, and bank activity are evidence. The goal is not to accuse faster. The goal is to detect better. Segment 5, theft by ineffective management, owner theft, and closing. Now we need to deal with theft by ineffective management. This may be the most uncomfortable part of the whole episode because it does not always look like theft. A manager does not have to steal from the drawer to steal from the business. A manager can steal profit through weak supervision, poor scheduling, bad ordering, no follow-up, loose standards, failure to train, failure to correct, and failure to inspect. Bad management is profit theft wearing a name tag. A manager steals profit when employees stand around while customers wait. A manager steals profit when the phone rings and nobody answers. A manager steals profit when the drive-through speaker is ignored. A manager steals profit when inventory runs short and the business has to buy emergency items at higher prices. A manager steals profit when overtime is tolerated without production. A manager steals profit when spoilage is not controlled. A manager steals profit when refunds, voids, discounts, no sales, and cash shortages are not reviewed. That may not be criminal theft, but it is economic theft. The money is still gone. The margin is still damaged. The owner is still paying for preventable loss. Management must have a leak tolerance point. If a manager earns $4,000 a month, but the business is losing $6,000 a month in preventable waste, Shortages, overtime, emergency purchases, lost sales, and customer complaints under that manager's watch. The owner is not buying management. The owner is financing confusion. Every supervisor must have measurable tolerances. How much cash shortage triggers review? How much inventory variance triggers investigation? How much overtime requires approval? How much spoilage is acceptable? How many customer complaints trigger retraining? How many unanswered calls trigger correction? How much vendor increase requires audit? How much revenue drop requires explanation? Without tolerance points, everything becomes explainable. And when everything is explainable, nothing is accountable. Management should reduce risk, not become another risk category. Now let us deal with the owner, because sometimes the owner is the leak. An owner can steal from the business by diverting resources, pulling too much cash out before the business is stable, using business credit for personal lifestyle, treating the business account like an ATM, failing to save for taxes, refusing to document expenses, using company resources for personal convenience while demanding employees follow rules. An owner can steal from the business by diverting attention, chasing every shiny idea while the current business model is leaking, posting content while payroll is inefficient, expanding while controls are weak, starting a new brand while the core operation cannot reconcile cash, inventory, labor, and bank activity. An owner can steal from the business by diverting innovation and creativity. A business needs better processes, better customer experience, better training, better offers, better systems, better marketing, and better financial controls. When the owner stops thinking, stops improving, stops measuring, and stops adapting, the owner steals future revenue from the business. The owner has to ask, am I draining cash? Am I draining attention? Am I draining the future? Am I blaming employees for leaks I allowed? Am I refusing controls because I do not want accountability either? That is a tough mirror. But businesses do not grow on excuses. They grow on truth. If you cannot trace it, do not trust it. If you cannot document it, do not defend it. If you cannot reconcile it, do not call it profit. Value add segment, when a red flag becomes a case. Now let me add one more layer because this is where some owners mess up. They finally see a red flag, then they move emotionally and destroy their own case. They accuse too fast. They threaten too fast. They fire too fast. They delete access too fast. They argue before they preserve evidence. That is how an owner can turn a real business problem into a legal, employment, partnership, or documentation problem. So here's the rule. When a red flag appears, slow your mouth down and speed your documentation up. If you suspect theft, fraud, misuse, collusion, partner misconduct, vendor manipulation, payroll manipulation, cyber compromise, or bank activity that does not make sense, do not wing it. Preserve the proof chain, save the POS reports, save the bank statements, save deposit images, save payroll records, save schedules, save delivery logs, save vendor invoices. Save video footage before it overwrites. Save emails, texts, order histories, access logs, refund reports, void reports, discount reports, no sale reports, and system user activity. Do not edit the records to make them prettier. Preserve them as they are. That is not paranoia. That is business discipline. And here is another missing piece. Employees often know before the owner knows. Somebody sees the shortcut. Somebody sees the drawer not being opened. Somebody sees the customer being handled off the system. Somebody sees the vendor relationship that feels too cozy. Somebody sees the food being overproduced. Somebody sees the partner using company resources like a personal wallet. If the business has no safe reporting channel, the honest person may stay silent because they do not want drama, retaliation, or being labeled a snitch. A serious owner needs a clean reporting path. Who do employees tell? How is the report documented? How is confidentiality protected as much as practical? And how does the owner prevent retaliation while reviewing the facts? A tip does not prove guilt, but a tip can tell the owner where to look. The next value add is access control. When a person leaves the company, changes roles, becomes suspicious, or has no need for access, the owner must review POS access, bank access, payroll access, vendor access, credit card access, fuel card access, email access, software access, camera access, keys, alarm codes, admin passwords, customer lists, and cloud folders. Do not just take the keys and forget the passwords. In 2026, the key may be a login, not a piece of metal. And when the situation becomes material, repeated, legally sensitive, or complicated, bring in professional help. That may mean a CPA, forensic accountant, certified fraud examiner, attorney, HR professional, cybersecurity professional, insurance advisor, or law enforcement. The owner control tools are designed to tighten the business and reveal patterns. They are not designed to catch every theft or replace professional investigation. Also review insurance and bonding. Does the business have employee dishonesty coverage? commercial crime coverage, cyber coverage, proper claim documentation, and a process for notifying the carrier when needed. Many owners do not think about insurance until after the loss, and by then, they may not have the documentation needed to support the claim. So the value add is simple. Do not just build theft prevention, build theft response. Prevention asks, how do we make the leak harder? Detection asks, how do we spot it faster? Response asks, what do we do once the pattern appears? That response system should be calm, documented, professional, and fair. Because the goal is not to accuse faster, the goal is to find the truth cleaner. Additional value-added tool descriptions. Anonymous tip and no retaliation intake log gives honest employees a safe, documented path to report suspicious activity without turning the business into a rumor mill. Evidence, preservation, and investigation. Whole checklist helps the owner preserve POS reports, video, bank records, payroll records, access logs, vendor invoices, and communications before evidence disappears or gets overwritten. Access rights and password audit reviews who has access to POS, bank accounts, payroll, vendor accounts, credit cards, fuel cards, email, cloud files, cameras, alarm codes, keys, and admin systems. Escalation decision tree helps the owner decide when an issue stays at owner review, when it goes to the CPA or bookkeeper, when a forensic accountant or certified fraud examiner is needed, when counsel should be involved, and when law enforcement may be appropriate. Fidelity bond, crime, and cyber coverage review helps the owner check whether insurance and bonding protection exists before a loss becomes a crisis. Surprise audit calendar creates randomized review points so dishonest behavior cannot simply prepare for the same predictable monthly inspection. So let us bring this home. Business owners, silent investors, partners, franchise owners, and absentee operators, stop confusing trust with control. Trust is not a system. Cameras are not a system. Hope is not a system. A system means cash ties to revenue, revenue ties to activity, activity ties to labor, labor ties to production, production ties to inventory, inventory ties to purchases, purchases tied to vendors, vendors tied to documentation, documentation ties to the bank ties to the books, and the books tied to owner review. If the chain breaks, the money can break. Before you accuse anybody, build the audit trail. Before you panic, examine the pattern. Before you fire somebody, document the facts. Before you blame the market, inspect the operation. Before you blame employees, examine management. Before you blame management, examine ownership. This is not about creating a culture of fear. It is about creating a culture of proof. Honest people should welcome clean systems because clean systems protect them. Owners should welcome clean systems because clean systems protect the investment. Managers should welcome clean systems because clean systems clarify expectations. And customers should benefit because the business becomes more reliable, more consistent, and more professional. Strategic hustling moment. Here is the strategic hustling moment for this episode. If you cannot trace it, do not trust it. If you cannot document it, do not defend it. If you cannot reconcile it, do not call it profit. Business owners, the hustle is not just making the sale. The hustle is protecting the sale after it happens. The hustle is making sure the money enters the system, the inventory matches the sale, the labor matches the activity, the vendor matches the need, the bank matches the books, and management matches the standard. That is grown business hustling. A street hustler watches the door. A strategic hustler watches the system. And if your system cannot tell the truth without asking the suspect, your system is not finished yet. Strategic hustling moment. Access without documentation is exposure. Trust without controls is temptation. Growth without reconciliation is gambling. Closing thought. Do not wait until the money is missing to become interested in the money trail. Ask how the business could be stolen from, slowed down, misused, manipulated, or neglected. Then build the process that makes stealing harder, detection faster, excuses weaker, and profit stronger. This has been Mic'd Up Money Reloaded. Like, share, subscribe, and keep building businesses that are profitable, protected, and prepared. For business consulting, visit eksbc.net. For tools, playbooks, and reloaded resources, visit mic'dupmoneyreloaded.com. Until next time, remember, the money you make is important, but the money you keep, control, protect, document, reconcile, and properly manage is what builds the future. There is no such thing as a trust system. A camera shows movement. A control proves money. And some people do not steal what you made. They steal what you could have made. Bad management is profit theft wearing a name tag. And sometimes the money is not stolen from the register. Sometimes it leaves through the vendor list. A spoiler should not become the employee meal plan. And if the answer is everybody, then accountability is nobody. The goal is not to accuse faster. The goal is to detect better. Sometimes the person zooming you is you. This episode comes with the Who's Zooming Who 360-degree internal theft and cash leak audit playbook. It walks you through cash entry points, daily closeout, POS exceptions, camera to receipt verification, register change controls, online and call-in reconciliation, inventory lockouts, bank reconciliation, expense documentation, vendor recognition, company credit access, time to activity tracking, revenue by hour review, slowdown detection, overtime and lingering employee control, mileage and fuel review, waste and spoilage control, customer capture red flags, sudden income pattern review, management leak tolerance, owner theft self-audit, outside employment conflicts, partnership theft controls, and the weekly 360 owner dashboard. This is the tool for owners who do not want to wait until the money is missing to discover the system was missing too. Core tool descriptions. Cash entry point map identifies every place money enters or should enter the business so nothing depends on memory or verbal reporting. Daily cash closeout sheet creates a daily proof chain from POS totals to drawer count, deposit, and bank activity. POS exception review flags voids, refunds, discounts, no sales, deleted tickets, and manager overrides that can hide theft or sloppy process. Camera to receipt verification matches what the customer visually received to what was actually rung up. Inventory lockout checklist controls access to high-value inventory, storage, receiving, transfers, spoilage, and cycle counts. Prompt bank reconciliation checklist forces quick review of deposits, withdrawals, transfers, ACH, debit charges, checks, and unexplained cash movement. Expense documentation proof sheet requires every expense to have a receipt, business purpose, approval, category, and support document. Vendor recognition and usage audit catches unknown vendors, sudden vendor increases, duplicate payments, vague invoices, and related party risk. Time to activity labor tracker attaches paid time to documented work, client activity, production, service, cleanup, delivery, or admin tasks. Revenue by hour audit sheet compares sales by hour to staffing, calls, customer flow, online orders, drive-through activity, and management coverage. Active work slowdown detection tool looks for revenue suppression through ignored phones, ignored customers, delayed orders, slow service, and intentional bottlenecks. Waste, spoilage, and overproduction tracker controls overproduction, waste, take-home product, and food or inventory costs that rise faster than sales. Customer capture red flag review examines customers who insist on one employee only and checks pricing, payment, discounts, and documentation. Management leak tolerance scorecard compares management salary to preventable losses in cash, labor, inventory, waste, overtime, and lost sales. Partnership theft and partner control audit examines unauthorized draws, related party vendors, customer diversion, personal use of resources, hidden bank activity, and unequal partner contribution. Owner Weekly 360 Dashboard gives owners, partners, and investors one recurring view of cash, labor, bank, vendors, inventory, customer flow, and unresolved exceptions. If you are an absentee owner, silent investor, partner, franchise owner, or business owner with outside management, and this episode made you realize your controls are too loose, book a business control and strategy call. We will look at the money trail, the management trail, the vendor trail, the labor trail, and the blind spots that could be costing you profit. Do not wait until the shortage becomes a crisis. Book the call, tighten the system, and protect the business before the leak becomes a flood. If this episode made you realize your business needs better numbers, better controls, or better owner visibility, visit eksbc.net and book a business strategy consultation. To get the Zoomin 360-degree internal theft and cash leak audit playbook, go to www.micdupmoneyreloaded.com. This is the practical owner control tool that helps you examine cash, inventory, labor, vendors, bank activity, waste, and management leakage. If you are hearing this on Bumpin' 96.3 FM or iHeartRadio, go to YouTube and subscribe to @MikeDupMoneyMedia for the extended conversation, clips, and reloaded resources. Follow, like, share, and subscribe. The money you keep is just as important as the money you make.
Mike check, money check, mindset check. This is Mike Up Money Reloaded, where entrepreneurs talk money, strategy, systems, and execution. No fake hustle, no empty flexing, just real business talk that gets you right. Mic'd Up Money Reloaded, talk that strategy, show it. Systems moving, profit growing. Real entrepreneurs already know it. No fake value, better own it. Price meets pain when the bridge is built. Execution turns the vision golden. If the plan is weak, the pressure gets felt. Mic check, hey. Money check. Woo! Mindset check. This ain't just motivation. This is business correction. This ain't just conversation. This is money direction. You want profit, build the model. You want growth, fix the flow. You want increase, check the numbers. What you don't know can stop the show. Make the money. Reload it, talk that strategy. Show it. Systems moving, profit growing. Real entrepreneurs already know it. Hey. No fake hustle, no empty flexing. No more guessing, no more stressing. Money, strategy, systems, execution. Reload the vision, rebuild the plan. Price the value, know where you stand. Mind the money, reload it. Bumping 96.3 FM. iHeartRadio, YouTube. Where entrepreneurs talk money, strategy, systems, and execution. Stop just listening. Start applying. Make the money, reload it. Let's get it. Let's get it.